Welcome to episode 14 of the SaaS Report. I'm your host, Matt Aird, founder at Sales Science, and today we're going to be taking a look at ServiceTitan's S1. So ServiceTitan has filed their S1 with the SEC, which means that they're going to be going public, right? So they're going for an IPO. So as a part of that process, they have to release a bunch of information about the company and where it's at. So that gives us an insight into some of the metrics, how they've been performing over the last few months. So we're going to do a deep dive there. And we're also going to take a really close look at Xero's performance recently as well. So Xero released their interim shareholder report, which covers the last 6 months of activity. So we're going to do a deep dive there and have a look at how Xero's performance has changed under the new CEO versus how they were performing prior. But before we get into any of that, let's have a look at the news. So Klaviyo reported Q3 numbers and the results were really good. So they added $237 million in net new ARR in just the last 12 months. So we did a big deep dive on Klaviyo's performance in episode 13 of the pod, where we looked at how they've grown from really early stage SaaS startup into a $10 billion company. Today we're looking at just the Q3 numbers. So they had 33% ARR growth. That puts them just shy of $1 billion run rate. And to continue the growth, Klaviyo's outlined 4 kind of core objectives or growth areas for the business. Number 1 is to sell more stuff to existing customers, right? So they're expanding out their product suite. They want to be able to continue to cross-sell and upsell their existing customer cohorts. The second is to continue their expansion internationally. The third is to expand upmarket. So at the moment, their ACV sits around $4,000 or $5,000 per customer. They want to move upmarket to be able to push that up. And then the fourth is to continue to add net new customers in their core segments, right? So just continue to do more of what they're doing. We can clearly see that they're ticking the boxes on a few of these growth drivers in this Q3 report. So the upmarket expansion is going very well for Klaviyo. They grew the number of customers paying them more than $50,000 a year by 54% year over year. And as a result of this, ACV actually increased fairly substantially as well. So that's up 15% year over year, right? So basically what that means is that if you take their annual recurring revenue, you divide that by the number of customers they have, that gives you your ACV, right? To increase that 15% in a single year is incredible, right? That's a massive move upmarket. And that's now pushing $6,000 per customer. So total customer count also grew. That's up 16% year over year. So that grew from 135,000 in Q3 of last year to 157,000 in Q3 this year. And if we look at their international expansion, right, this is one of their key priorities. International expansion is keeping pace with their growth in the Americas. So the way that we can see this is based on the revenue split by geography. So this is something that Klaviyo reports out, which is, how much of our revenue did we generate in the Americas versus APAC versus EMEA. So what we can see is that, the numbers have remained pretty consistent. They're generating 21% of their revenue from EMEA and 10% of revenue from APAC in Q3 of this year, right? So that's staying consistent. So whilst we're not seeing an increase in those percentages, that's probably what we would expect, right? Because if they're trying to continue the expansion internationally, they don't want to do that at the expense of growth in their kind of core home markets, right? So what we should see is that those percentages should stay roughly the same if they're growing kind of both markets at a similar rate. So good, tick the box there. Now, if we look at go-to-market efficiency, so they spent about $15,700 on sales and marketing per net new customer add in Q3, right? So that gives them a CAC payback of 28 months, and it's up slightly from 25 months this quarter last year. So go-to-market efficiency slowed slightly. NRR remains strong at 110%. And from a business efficiency standpoint, they've made some really good strides, right? So operating margin improved massively. So in Q3 of last year, they had a negative 171% operating margin. In Q3 of this year, that's down to just negative 5.7%. So almost a break even from an operating margin standpoint over the space of a year is amazing. So that reduced their operating loss to just $13.2 million for the quarter. Free cash flow increased a lot. So that's up to $34 million from $22 million in Q3 of last year. So that's a 15% free cash flow margin versus 12% in Q3 of 23. So all in all, Klaviyo is just, they're on a roll, right? They are ticking all of the boxes, they're hitting all of their targets, and they're still pretty cheap, right? They're only trading at 10.5 times ARR, which puts them kind of towards the low end of this, like these faster growing kind of, $1 to $2 billion SaaS companies. So seems cheap to me, but yeah, just a business that continues to tick all the boxes. Another really good quarter from Klaviyo. We got Q3 numbers from CrowdStrike as well. So if you remember back to Q2, CrowdStrike caused the blue screen of death outage to about half of the computers around the world. And despite that, they still managed to add $180 million in net new ARR in Q3, right? So all of that revenue has come in post the outage that they caused. That took annualized subscription revenue up to $3.85 billion, but sales efficiency has dropped pretty dramatically year over year. So CAC payback has increased to 31 months from 21 months in Q3 of last year. So that's up almost 50%. And then magic number is down 35% to 0.50. Free cash flow margins were also down, so 23% for this year versus 30% for Q3 of last year. And these wobbles can probably be attributed to the outage, right? The company has made some concessions to customers in order to make up for the issues caused in the outage in July. So some of these concessions include things like flexible payment terms. So they're allowing their customers to come on board or their existing customers to continue to use their services with extended payment terms. They've delivered contract extensions. They've included additional professional services to customers at discounted rates. And so all of this has been impacting kind of the revenue line item. And the company said in their remarks on their Q3 earnings call that they might see a bumpy fourth quarter as well. So the CFO mentioned that they don't have full visibility yet into how the outage and some of the deals that have pushed as a result of that, how that's going to impact those deals coming into Q4. The other thing to note on Q4 is that's a big month for them in terms of retention. So they've got a bunch of customer contracts that are up for renewal in Q4. So that NRR, GRR, retention rates metric will be coming under the microscope in Q4. So a really big quarter for them coming up. This will kind of be, I think, the washout from most of that outage that they had in July. We should see a lot of that kind of resolve itself in the Q4 report. So it'll be really interesting to see how those numbers come out. But despite all of this, right, all of this going on, the decrease in go-to-market efficiency, the reduction of free cash flow, the issues with visibility into the sales pipeline, they're still trading at a massive premium, right? So trading at 22.5 times ARR right now. Also got Q3 numbers from Workday. So Workday is truly at scale, right? They're at almost 8 billion in ARR now, and ARR up 16% year over year. So just in Q3 alone, they added $224 million in net new ARR, added over $1 billion in the last 12 months. They generate this growth with really good go-to-market efficiency, right, for a company of their size. So magic number came in at 0.49, CAC payback of just 32 months, free cash flow margin of 17%, generating $360 million in free cash flow for the quarter. That was down about 8% year over year, right? And in the earnings call, we got some insight from the executive team on the expected growth rates over the next couple of years. So they expect to be able to continue to grow the business, right, at 8 billion at about 15% per year. And the two things that are going to fuel that, number one is continued expansion into federal government contracts. So Workday's had some success in the last couple of quarters, getting into federal government departments and replacing on-premise solutions with their cloud-based offering in both the human capital management and ERP side of things, right? So they told us that 80% of government departments still operate on-premise human capital management and ERP solutions. And they expect, Donald Trump and Elon Musk's DOGE, Department of Government Efficiency, to be a really big tailwind for them, right? Because these systems are typically, expensive to maintain. They're not capital efficient, right? And so they expect that this is going to provide a pretty good tailwind for them as these departments are looking for efficiency, as they're looking to try to consolidate. Workday thinks that they'll be well positioned to be able to continue to come in and pick up more federal government contracts, which is a big growth area for them. They haven't had a lot of success in that department in the past. The second growth driver, which is going to fuel them at 15% a year for the next couple of years, is increased AI adoption. So they've said that they've seen some really good signs early on from their AI products, with about 30% of their product expansion sales, including an AI product in Q3. right? So that means that of existing customers that came back to Workday and bought more things from them, 30% of those purchases included AI, right? And they think that that's going to continue, and we should see, obviously, as everyone expects, right, continued AI adoption. They think that they're pretty well positioned to benefit from that. So if they hit these marks, right, Workday at the end of 2027 will be doing, more than 10 billion in ARR, right, which would put them as just kind of I think the fourth company off the top of my head to reach that mark from a pure play SaaS company perspective. And they're trading at just 8.5 times ARR right now. PagerDuty reported Q3 results last week, and growth is really slowing down for them. So just 9% ARR growth year over year in Q3. And for a company doing just 500 million in ARR, that's not a great sign, right? We say only 500 million, but from a public SaaS company standpoint, that's still at the lower end. And it's really not where they want to be, right? If you look at the best companies in the world, they grow through that, 2, 5, up to $1 billion run rate marks very quickly, right? So as some comparables here, right, Monday grew through this run rate at about 50% ARR growth. CrowdStrike was growing at almost 100% at a similar ARR run rate, and even HubSpot was growing in the mid-30s at around 500 million. So they really need to find a way to get that growth rate to accelerate again, right? Sitting in single digits is not great, right? For context, Salesforce grows at 9.5% and they're at $36 billion in revenue, right? So a lot of work there to do for PagerDuty to get that back on track, but there are some signs of life. So magic number is up 167% year over year, up to 0.24. CAC payback is down 63% to 61 months. So obviously those numbers, to see percentage improvements that high and to still be so far outside of the ideal range means that, we're obviously coming off a very low base, but they are trending in the right direction. They've got their work cut out for them if they want to get back to those 20 to 30% growth ranges at a minimum. And this slow growth means that the stock is getting punished in the markets at the moment. It's down more than 50% from its kind of pandemic highs, trading at just 4 times ARR right now. So ServiceTitan lodged their S1 recently. So an S1 is the form that a company has to register or lodge with the SEC when they intend to go public or to IPO. And as a part of that process, we get a really detailed look at the state of the business, right? Where they're at, what do their financials look like, what do their metrics look like? And this is often the first time that we get these insights because the companies are private up to this point, right? So we don't have the same level of transparency for these private SaaS companies as we do the ones that are public or planning to go public. So ServiceTitan, for anyone that isn't familiar, is kind of a workforce management solution, and they sell specifically to trades-based businesses, right? So think like plumbers, electricians, HVAC companies, anything that's kind of like trades-based where you've got people out in the field and you need to organize that work, you need to schedule people, you need to get paid for that work, you need to quote, you need to manage your customers, right? All of that stuff. So ServiceTitan is a platform designed for these companies to be able to manage their business operations. Very similar to, for the Australian, New Zealand viewers, very similar to a tool like Simpro, right? Compete in very similar markets. So it's founded in 2007 by Ara Madesian and Vahi Kasoyan. Apologies if I've butchered your names there. And as at January 31st, 2024, it scaled the business to about 700 million in ARR, about 8,000 customers and about 2,500 employees. So it's been growing very strongly over the last couple of years, 51% compound annual growth rate from 2021 to 2024, and then they generated 31% revenue growth between the year 23 and 24. But they're still running pretty big losses. So operating loss of 183 million in fiscal 24, which comes in at about 32% of revenue, right? So yeah, big operating losses on the company there. They spend about 36% of revenue on sales and marketing, 33% on R&D, 22% on G&A. That G&A spending is a little bit high. That will obviously normalize as the company continues to scale. But R&D and sales and marketing are pretty in line with what we see for most kind of public SaaS companies. So the reason why that they have these big operating losses is not because of kind of the OpEx spending line necessarily. It's because their gross margin profile isn't the best, right? So they've got 2 revenue lines. They've got platform revenue, which is made up largely of subscription-based payments from their customers for use of the platform. And then they've also got a kind of a payments line item as well. So they facilitate payments between their customers and the end kind of, users. So think, their customers, plumbers, They go out and they do a job. They facilitate payment between, the end customer and the plumber. But they don't own any of that payment infrastructure or those payment rails. And so the revenue that they generate through that payment line item, the ticket is clipped on that a lot by their partners, right? Whether that's in payment processing fees or usage fees. So we see a similar dynamic in a company like Shopify, right? You've got subscription revenue, which is really high gross margin, and then you've got typically this like payments revenue, which isn't as high quality, right? Yeah, it's easy to kind of like manage and generate, but the gross margins off the back of that just aren't as strong. Now that payments revenue for ServiceTitan represents about 14% of their platform revenue, right? So 86% of that comes from the subscriptions for access, and then 14% comes in the form of that payments volume revenue. So then on top of that, so we've got the platform revenue. On top of that, we've then got professional services revenue. So this is fees that they charge to customers for providing them help with onboarding and training and support packages, and even some marketing services as well that they deliver to end customers. The idea behind these professional services is that it helps the customers to better adopt the solution, right? So it gets embedded within the business. Everyone that needs to use it knows how to use it. So that customer is going to be happy and ideally, right, not churn in the future, right? They're going to use the platform for the longer term if they can get off to a good start. Problem for ServiceTitan is that this line item runs at a significant loss, right? This is unusual for SaaS companies. You quite often see the professional services revenue as just break even or even loss leading. But the losses for ServiceTitan here are probably larger than anyone would want them to be. So they generated about $32.6 million in revenue in fiscal 24 on professional services, and it cost them $68 million to deliver those services, right? So what that does is when you generate such a big loss on professional services and it makes up a meaningful portion of kind of the revenue that you generate, or at least the cost of goods sold, that has the impact of really pulling down gross margins, right? So the gross margin, the blended gross margin for ServiceTitan is sitting at just 61%, right? Now, if you compare that to kind of like pure play SaaS companies, right? We typically see that more in the like 80, 85, even up to 90% range. For ServiceTitan operating at just 61%, what that means is they've got a lot less kind of like money left over after delivering services to spend on things like R&D and sales and marketing and G&A, right? The bucket of money effectively is reduced before we even get to the portion where we can allocate spending for future business development, right? And so this means that in order to spend really aggressively on R&D, to spend really aggressively on sales and marketing, and they need to run pretty big losses. And I think this is one of the reasons that we haven't seen ServiceTitan go public yet, right? So despite the fact that they're at about 700 million in ARR, they're only just going public now. And the reason for that is that over the last year and a half to 2 years in SaaS, the big thing that everyone's been focused on is, operational efficiency, right? Show me that you can generate free cash flow. Show me that you can get to positive operating margins. And ServiceTitan just really hasn't been in that position for the last couple of years. Yeah, they've had good top line growth rates. ARR is really strong, but they've really struggled from like a business efficiency standpoint. So that's obviously been the focus for them over the last 12 months as they've been preparing for this IPO, right, to go public. So they've reduced their operating loss in the last 12 months from negative 47% of revenue to negative 29% of revenue. So they are pulling that back, but they're still a long way below where they would need to be to justify those really high ARR multiples that we see for companies today, right? And to get those, basically where you need to be today is really strong operating margins, operating income and free cash flow, and 30% plus ARR growth rates. If you can tick those two boxes, you get a really high multiple. If you're missing on either one of those, you get punished pretty severely. But from a go-to-market standpoint, right, they're doing pretty well. So CAC payback was 27 months in the last fiscal year. Magic number was 0.63, NRR of 110%, gross revenue retention of 95%. Total customers grew from 6,800 to 8,000 in the last fiscal year. Now, one area that I was pretty surprised by looking at ServiceTitan's S1 is the degree with which they've had success moving up market. So if you think of these kind of like trades-based businesses and platforms designed to cater to these trades-based businesses, you often think of kind of like small ticket sizes, right? There's lots of these trades businesses that are quite small in nature, right? It's like an owner and a few employees, but they've had a ton of success moving quite a long way up market, right? So they've now got more than 1,000 customers that pay them more than $100,000 per year. And that number has doubled since January of 2022. Right, on top of that, those customers generate about 50% of ServiceTitan's revenue, right? So you've got 1,000 of the 8,000 total that contribute about 50% of the revenue of the business. And what this does is it really pushes up the average contract value. To figure out average contract value, you take the ARR, you divide that by the total number of customers. If we do that for ServiceTitan, we get $72,500 per customer in annual contract value. Now, for a company that's servicing these small trades businesses, right, that seems really high. I'd expect that the median would actually be much lower, right? That's because I'm guessing you've probably got a bunch of customers that are paying them a couple of grand a year, potentially, right? $5,000, $6,000, $7,000, $8,000, $9,000, $10,000 per year. And then you've got that 1,000 that are on the, $100,000 a year mark. So in the middle, right, I'm guessing the median is probably quite a lot lower than 72,500. But because you've got a bunch of these, kind of like whales spending a lot, that average gets pushed up a little bit. But ultimately, that's going to be a good thing for the business, right? If they continue to move up market, if they can continue to get customers paying them $50,000, $100,000, $200,000 per year, that makes go-to-market a lot easier, right? You've got fewer customers to service, they're paying you more, business operations kind of get simplified in that sense. There are also some real tailwinds here from a market dynamics standpoint. So you've got a situation in North America at the moment where private equity companies are rolling up these really, these small trades-based businesses. So data from PitchBook tells us that private equity companies have acquired about 800 home services businesses. So think like HVAC, plumbing, electrical companies since 2022. And the strategy that these PE companies will be deploying is to roll these companies up, right? So you go and buy a bunch of smaller HVAC companies, you roll them up into a single group, and you kind of like consolidate the systems that they run on. And so if ServiceTitan can get in with those companies conducting those roll-ups, right, then they're able to, pick up 4, 5, 6 customers for the price of one effectively, right? The market is being consolidated, which means they have fewer customers that they have to chase and go after. And each one of those deals that they secure is worth a lot more. So there's, these market dynamics that are also helping them to push that ACV up over time. So there is an interesting dynamic hanging over ServiceTitan's IPO. And that is this thing that I haven't come across before called a ratchet clause. So the idea behind this ratchet clause is to protect the downside of a late stage investor, right? So in 2022, ServiceTitan conducted their last private fundraising round. As a part of that fundraising round, they agreed to this term, which effectively set a deadline for their IPO date for May of 2024. The agreement is structured such that if ServiceTitan fails to IPO in May of 2024, the price required will compound each quarter at a rate of 11% annually. So effectively in the agreement, ServiceTitan's hurdle rate was $84.57 per share. Right, so if they IPO'd in May at $84.57, the clause would effectively vanish, right? It wouldn't exist, and everyone gets their allocated shares at the price point and everyone's happy. Since the deadline has already passed, that ratcheting rate has now taken into effect, and the price that ServiceTitan needs to hit is now more likely closer to $90 a share. All right, so if they were to IPO today, they'd have to hit $90 a share to avoid further dilution to the investor that holds this clause. In the private markets, so in secondaries markets, the share price is valued at about $81.59. So that represents about a $7.3 billion valuation. So not enough to hit the hurdle rate, which means that if they are to IPO without anything dramatic changing in the business or the kind of macro landscape for SaaS companies, investors, existing investors, founders, employees are probably going to see some dilution here. Now let's take a closer look at that like $7.3 billion valuation and see how that stacks up based on where they're at currently as a business, right? Now, if we assume a 25% growth rate in the last 6 months, so 6 months from the time that we got the last financial information from them, that would put them at about $790 million in ARR right now, right? So at a $7.3 billion valuation, that's giving them about a 9.2 times ARR multiple. That puts them in the same ballpark as Procore. So Procore, interestingly, in the construction space as well, they're trading at about 10.2 times ARR currently, right? Procore's at just north of $1 billion in ARR. They're growing kind of in the mid 20% per year. They have negative operating margins as well, but kind of nowhere near the level that ServiceTitan does. Procore has negative 12% operating margin. ServiceTitan is closer to negative 30%. Procore has a much better gross margin profile. So they're coming in at 83% gross margins, which gives them a lot more flexibility, as we talked about, from like an OpEx spending standpoint. But ServiceTitan kind of edges them out on go-to-market efficiency, right? So magic number of 0.63 versus Procore 0.36, and then a CAC payback of 27 months for ServiceTitan, 41 months for Procore. Both have very similar kind of like GRR, NRR metrics. So I think, yeah, this is a pretty good comparable, right? I think I wouldn't be surprised to see them land at like a 9 to 10 times ARR multiple at the point that they do go public, which again is probably going to put them below that hurdle rate, which means they're going to see some further dilution at that IPO point. Last thing I want to cover here is just the fact that, right, what we see in ServiceTitan is another example of a platform play, right? They do almost everything that these trade-based businesses could want from a business management solution, right? Helps them manage customers, helps them schedule their employees, helps them, do quotes, helps them with sales and marketing, helps them from a financial perspective, helps them from a billing standpoint, right? If you're a trades-based business and you buy ServiceTitan, it basically does everything you need it to in order to operate your company. What we've seen over the last couple of years is this massive explosion in like point solutions in SaaS. Right, so SaaS applications designed to do one very specific thing, but not cover all of the other things that a company could want, right? And I think what we're seeing now is more of a transition back towards, platforms being the play and less so about point solutions, right? We had this massive explosion in SaaS applications. Everyone got used to using, 50 to 100 different SaaS apps within a company. I think we're now starting to go back the other way. And it's like, we want to consolidate this spend as much as possible. Right, point solutions are out, platforms are in. I think they're very well positioned to take advantage of that, right? If you're a trades business, you don't want to be in the position of having to manage, 30 different SaaS apps to manage your company. If you can streamline that down to 5 or 6, you're going to be much more likely to go down that path, right? So I think, ServiceTitan's very well positioned to ride that wave as well. So we'll keep an eye on this. We don't know when they plan to go public or when the IPO is, but we'll keep an eye on this and see how this plays out over the next few quarters. So Xero released their interim shareholders report, and this report covers the business performance over the last 6 months, right? So ending September 30th. And the overwhelming theme from this report is that SMB SaaS can work, right? So in the last episode, we talked a little bit about Jeremy Horowitz's critique of SMB SaaS and the fact that, software companies that charge really low subscription rates, prosumer to very small businesses, those SaaS companies can't scale, right? They can't generate efficient enough unit economics to allow them to scale and be profitable. And I think Xero just blows that out of the water completely, right? So Xero's average customer pays them $500 per year. Ending September 30th, they generated 22% ARR growth over the last 12 months, taking them to more than $2.1 billion in ARR. Right now, get this, they have more than 4.2 million customers, which is like really hard to wrap your head around that challenge, right? And I think this is part of the critique that Jeremy has, which is like trying to design a go-to-market motion and then an operational motion that allows you to service 4.2 million customers is really hard, especially when each of them is only paying you $500 a year, right? It's like, how much time and attention can we actually give to each individual customer if we only generate $500 a year in revenue off them? But Xero's just found a way to make this work, right? In the last 6 months, they spent on average about $640 to acquire a net new sub, and that CAC gets paid back in 14.9 months, and that's actually down 4% year over year as well. This is incredible. CAC payback of 14.9 months. Of the 35 public SaaS companies that we track, there's only one company that performs better than them, and that's Atlassian. So the median for Q2 across the SaaS companies that we track was 33 months. And as we can see here, right, even high performers like Monday, CrowdStrike, Snowflake, they're not able to get CAC payback below 30 months, right? And Xero's sitting here at 14.9. Right, now let's go back to growth rates. So generated 22% ARR growth year over year. Median across the companies that we track was bang on 22%. So growth right in the middle of the pack here, on par with companies like HubSpot, Procore, Smartsheet, and Viva Systems as well. One of the other cool things about Xero and their reporting, they give us really detailed insights into churn and LTV metrics, or lifetime value metrics as well. So monthly recurring revenue churn for Xero came in at just 1%, so up from 0.94 a year ago. That means that based on their average contract value and that churn rate, the LTV of a customer, the lifetime value, is about $4,063. And that gives them an LTV to CAC ratio of 6.3. So basically what this is telling us is that for the $640 that they spend on acquiring a new customer, over the lifetime of that customer, they'll generate 6.3 times that in revenue from that customer. Right? So really efficient, CAC and go-to-market engine, even at a very low kind of average revenue per user number. This is an outlier in this space, right? It's typically really hard to scale these SMB SaaS businesses because churn is so high. When you've got low average contract values and you've got those customers leaving you regularly or churning out, it makes it really hard to spend anything on sales and marketing to acquire them, right? Because let's say you spend $500, that customer's only spending $50 a month with you. If they leave after 6 months, you've just lit $200 on fire, essentially, right? So for these SMB companies, controlling that go-to-market spend and then controlling churn as well is super important. And Xero just has that dialed in at this point. So in this report, we also get a really detailed breakdown on how the business is performing in different geographies. They split the geographic reporting into 5 separate areas. So we get Australia, which is their largest market, the UK, which is the second largest, then we get New Zealand, the US, and then what they call the rest of the world. Australia is the largest region for them by far and continues to grow at the fastest rate as well. They generated $458 million in revenue in Australia in the last 6 months. That's up 27% year over year. They've got 1.86 million subscribers in Australia, and that subscriber base grew 10% year over year. The UK is their second biggest market, so that was 271 million in revenue in the last 6 months, up 26%. And subscriber growth was up 6% to 1.07 million. Right, then we've got New Zealand, that's the third biggest market. They had revenue here of 109 million over the last 6 months. Right, so just think about that. They've grown basically a company servicing just New Zealand to almost $220 million in ARR. Right, off a population of, 5 million people. It's just incredible. That's up 13%. 614,000 subscribers is up 5%. And then we have Xero's Money Pit, right? Absolute Money Pit, which is North America. So they've been trying to penetrate this market for a long time now. Revenue in North America for the last 6 months was only $59 million. That was up 25%, but subscriber count actually reduced year over year. That was down 8% to just 365,000 subscribers. So it's safe to say that Xero really hasn't been able to make any meaningful progress into that US market. That is a market that's dominated by QuickBooks, right? And Intuit is the parent company of them. QuickBooks or Intuit does about $10 billion in revenue in their small to medium business segment. So this is the company that Xero is competing with directly in that market, and they're finding it really hard to get any traction, right? But doing really well in Australia and the UK, which are their two kind of core growth markets. So in November of 2022, Sakina Singh Cassidy took over as the CEO of Xero. So since taking over, Cassidy has done a really good job moving the business away from kind of growth at all costs mentality through to, fiscally responsible growth. So she took over almost right at the time when this transition was happening in SaaS, right? Which is, okay, we can't just spend anything to grow ARR now. We have to, build a business that is sustainable from a free cash flow and an operating income standpoint. And we can look at how she's performed by going back to a comparison point, which was the 30th of September, 2022. So this was the interim shareholders report that came out just 1 month before she took over as CEO. So at that point in time, ARR was at 1.48 billion, right? 2 years later, they're at 2.164 billion. In 2022, the growth rate was 31%. That has come down a little bit to 22%, right? But as we say, that is at about the median of the public SaaS companies that we track. So still decent. Operating income in 2022 was 6.37 million for the last 6 months. This year, it's at 176 million. Free cash flow was at 15.6 million. This year, it's at 209 million. CAC payback was at 15.3 months. That's down to 14.9 months. So the focus for Xero over these last couple of years has effectively been the same as it has been for every other kind of public SaaS company, right? And that is, how do we transition from growth at all costs through to fiscally responsible growth that generates a bunch of free cash flow and operating income? And so Xero have decided to focus on this rule of 40 metric in order to help guide that transition. What they've done here is increased Rule of 40 from 33 in September of 2022 up to 43 in September of 24. And the way that they've done that is focusing a lot more on the efficiency within the business, right? So they've improved gross margin from 87% up to 89% in the last 2 years. They've reduced spending on sales and marketing from 36% of revenue down to 32% of revenue. And they've reduced R&D spending from 35% of revenue down to 29% of revenue, right? So that's improved kind of the spending side of the equation, right? Then on the other side, in terms of generating more revenue, there's been a very concerted effort to increase average revenue per user over the last 2 years, right? So that's up 22% in the last 2 years. So from $35.30 per month up to $43.08 per month. So Xero is just a company firing on all cylinders. They are proof that SMB SaaS can work and work really well. And they're trading at 13.4 times ARR right now, which puts them on par with the likes of Monday.com. That's it for this week. Thanks for tuning in. If you've watched this far and you're not subscribed to the channel yet, if you could do so, it would mean a lot to me. And as always, if you have any feedback, thoughts, suggestions, any topics you want me to cover, let me know. I'm trying to make this as fun and entertaining for you as possible. So thanks a lot for tuning in. I'll see you next week. Until then, goodbye.